continue to see that there is an underexposure for most of those that I just mentioned to our space, our segment, enterprise software. It's the fastest growing. It frankly, has some attributes from a returns perspective that are higher than all the other, investment, segments that are out there. It has the greatest number of 3-time return funds than any other segment out there. But yet I see people are still underexposed, even though every single company that they're investing in, the principal way in which they are creating value is embracing more software in their business. And I tell them, institutional investors all the time, and I say, okay, if you're looking at that sector, just double click one more time in the companies you're investing in and how are they creating their returns. And often it is they're bringing some efficiency to their operations by bringing in more software. I said, well, that should give you a clue as to what they're relying on to create value in those businesses. So why not just remove that secondary, risk of that underlying industry by being in the software that powers that industry? There's no correlation, which is actually interesting, in the returns of the software businesses to the underlying industry and how that underlying industry has done, because it becomes mission critical and business critical. And if that industry is open or those companies are in business, they have to buy the software. One of the interesting things, Simon, that also came out during this pandemic is people stopped paying their bills to pay for their rent, but they paid their software bills. Now think about that. Our retention rates actually went up. That's when you talk about, okay, what was more reliable and durable as an asset class, and software has clearly emerged in that regard.